Hey everybody, welcome back to Whiteboard Finance. In today's video, I'm going to update you on where my M1 Finance portfolio is at. I haven't done one of these in a few months, and a lot of you are asking me to update this. I'm not updating or doing this video just for the sake of showing you where my portfolio is at. I'm actually doing this because there's two lessons to be learned where I was a bit of a hypocrite in terms of what advice I've given in the past versus what I actually did with my own money. And the reason why I'm showing you this is to show you that you should listen to what I said to do, not actually do what I do. But it's all good. It's not even that big of a deal, but it's just to prove a real world point as opposed to a hypothetical one. So let's get right into it real quick. So if we look at these three different portfolios sitting on M1 Finance, as always, you guys are familiar with the SEP IRA. This is the one where I contribute $230 a week, which comes out to be $1,000 a month, $12,000 a year in this retirement account. This is basically just a dividend portfolio, and you can see here over time, there's a lot of individual stocks in here that are growth and dividend stocks. A lot of those are dividend aristocrats, but it's still going to be ETF heavy, ETF and REIT heavy. So we have VYM making up 20% of it, VIG making up 20% of it, Schwab making up 10% of it, and then Vanguard's real estate ETF. This is commercial real estate, REITs, if you will, which stands for Real Estate Investment Trust. This makes up 10% of it. So basically 60% of this portfolio is ETFs anyway. So the reason I want to show you this is because this is lesson number one. You can see here time in the market. The return is about 36% with the dividends reinvested, which for being a very conservative portfolio is very good. The reason for this is because I started this portfolio essentially in February of 2020, a month right before cerveza sickness, and the portfolio has done very, very well. And you can see over here, it stagnated just a little bit after all the turbulence going on with Russia and Ukraine, and then also all the rate hikes that will be happening this year. A lot of that stuff is already getting priced in. Now, here's the second lesson that I wanted you to take away from this video, and this is my income portfolio. So if you guys remember this, I started this in basically September of 21, so very late last year, basically Q4 of last year. I dumped in 100 grand, which you can see right there. And the reason for this is because this money is earmarked for something which is going to be happening here in about a month or so. And these funds were never meant to be a long-term portfolio. I actually made a video about this saying, hey, you know, I bought these three stocks or something along those lines for $100,000, and this is what that portfolio is. So you can see here since September of 2021, we're basically looking at essentially 6 months now, give or take. You can see that the portfolio is actually down $870. So the reason for this, the reason I started this portfolio is because this was supposed to be where I'm parking my money for incredibly high income. So this portfolio in and of itself, it's made up of 4 funds right here. All of these funds pay an extremely high dividend. I think the average yield of this portfolio is somewhere around like 7 to 8%. And the reason I did this was because I wanted to not park my money in a savings account making nothing. I wanted to at least invest in those four funds right here to at least collect 7 to 8% on my money, and that's paid out monthly. The 7 to 8% is annually, but it's divided by 12, so you get paid every month. So you can see here that the net cash flow I have in this is $161,351. That's with the $5,500 in dividends that I've earned. But even with the $5,500 in dividends, the gain of this portfolio is actually negative $6,300, resulting in a total loss of $865. So in the grand scheme of things, this is less than 1%. And I've seen other YouTubers, they're recommending individual stocks that are down 50, 60, 70, 80%, 90%, just complete clown show. But the reason I'm a hypocrite and the reason I'm showing you this lesson right here is because I always told you for years now in all my other videos, never invest in stocks unless it's going to be for something that's 5 years out, okay? 3 to 5 years. 3 if you want to be a little bit more risky, 5 if you want to be more conservative. So say, for example, you want to save for a down payment on a house, okay? And you know that you want to save 20%, whether that's right or wrong, just pretend for the sake of conversation you want to save 20%. And you say, hey, Marko, I got all this cash. I got 100 grand sitting in my bank account. I'm getting crushed by inflation. My bank account is yielding 0.4%. Inflation is 7.9%. My purchasing power is being eroded. Why don't I take that 100 grand and, invest it in the market and grow it that way? So by the time I want to buy this house, I have my down payment and at least it's kept up with inflation, right? My advice for years has been, if this is a purchase that isn't at least 3 to 5 years out, okay, you should keep that in a liquid money market account, savings account, somewhere where it's very liquid and it's not going to lose money. So I was a hypocrite because with this portfolio, this money was earmarked only like 6-7 months from the time of this investment. So from the time of September 24th, 2021, I knew I was going to be using these funds like 6, 7, 8 months from now. And that time is coming up here pretty soon. So not only did I go against my own advice, but this is a real life lesson that shows you if I would have at least kept this in a money market account or savings account, not only would this not be negative $865, this would actually make 0.4% on this, 161 grand or whatever, 161 grand minus 5,500 grand in dividends. So let's just say $156,000, for example, of my own money. So the reason I'm showing you this is because don't chase yield and also don't invest in something, if the purchase or what you're saving for is not at least 3 to 5 years out, if that makes sense. So that's me being a hypocrite. However, I know for a fact that this portfolio, it's going to be fine. This was never a long-term hold anyway, and these dividends are going to hit pretty soon here, which is another like $1,100. So I'm going to be back in the black anyway, and I'm not going to take a loss on this portfolio, but this is just a really good lesson. So the third and final portfolio within this M1 Finance account is the taxable one. And this is another lesson that I wanted to reiterate for lesson 1, meaning time in the market is better than timing the market. So you can see here, I have $125,826 of my own money with dividends plowed back into this portfolio. And the portfolio is only up 5 grand, which is a modest return of 6.45%. That's actually not accurate because this portfolio grew a ton. This portfolio was actually started in February of 21. And it grew a lot, which you can see in this chart. But I actually took out, you can see how it goes from $119,000 to $7,000, and then it goes back up to $117,000 and then back to $68,000. The reason for that is because I thought I needed 100 grand right here, so I took it out of this taxable portfolio. Realized I didn't need the 100 grand, and then like a week later or so, I realized I needed 50 of it, so I took out 50 right here. So ever since then, I've been adding money back to it. So this actually skews the return. The return is much higher than this, but I actually realized my profits, if you will. So this is just buying back at a higher cost basis. So don't do this. This is not something that you should do, but this taxable account was the easiest and most liquid way to get that money that I needed. So I guess the lesson in this is just keep your money in there, know what you're investing in, and let it ride, okay? So the overview of this entire portfolio with my Roth IRA, which I have not added to in a couple years now, the reason for that is because my wife and I were past that income level. We make too much money. And that's not to brag or say anything like that, but it's just we're literally past the legal limit to contribute to a Roth. We can do a backdoor Roth. We can do a simple 401k. We can do a SEP IRA. We can do a million different things. But this is just those 3 portfolios that I showed you, plus a Roth IRA from when I was younger. So I have more than this invested in the market, but this is what's being tracked on Simply Safe Dividends. But the thing I wanted to show you is not to show you how much money I have in stocks. That would be stupid and sociopathic. But it's the annual income is what I wanted to show you, and the dividend yield. So the bad news is that this dividend yield doesn't even keep up with inflation. So if you look at 4.25%, you're actually about 3.5% under CPI and probably 10% under actual inflation when you look at middle class real world costs for middle class people. But the good news is that this portfolio makes me essentially $17,000 a year without doing anything. And that's reinvested back into the portfolio. So that's the good news. So the reason I'm showing you this is because if you get to a critical mass or even a higher balance than this, and if you really want to focus on yield, you can make pretty good money per year and essentially retire just off that. That's obviously not accounting for safety withdrawal rate. That's not accounting for rampant inflation, and that's also not accounting for, increased living costs, if you will. But, if you get to a point where you have, a stressful job and you want to live off dividends, this is almost going back to that coast fire that I did a video on about a month ago, to where, you invest, you get to a certain metric, you keep an easier job or your day job, and you let the market do the rest to where it gets you to your number where you have to be of retirement age. So you don't have to put another penny into that portfolio, if that makes sense. So you're kind of coasting until retirement. So I'm somewhere along those lines. Again, I may make a video about why I don't care for the fire movement in general, but coast fire is probably the most reasonable out of all of them. And then just very quickly, if you guys want to get free training on M1 Finance, I basically show you how to use the platform, how to set up these pies. I'm not going to share with you exactly what I have in all these portfolios, because I'm going to save that for my private membership group, which is going to be Whiteboard Finance University. I give out an exorbitant amount of free information on this channel. I actually, want to start putting stuff behind a paywall so I can be 110% transparent with you guys there. So that's all I got for this video. I appreciate you following along. Again, the portfolio, at least those 3 portfolios plus my Roth, is sitting at $383 grand. Things only get better when you have a spouse who's working. Big shout out to my wife. She just got a nice job offer. She finished for her nurse practitioner, passed the boards in October. She went through a bunch of interviews, like 5th round, 6th round, a bunch of crazy interviews. And then she finally got a job offer a couple Fridays ago. So that's good. And she's at a government hospital. They have, pension, which I may make a video about pensions, but you can't rely on pensions anymore. It's not the 50s. But a lot of them are not fully funded. They may not pay out what they promise, but it's still better than, hoping and relying on the stock market for your retirement. So this is just a piece of the puzzle, guys. Stocks are just a piece of the puzzle, especially in times like these. You should be looking at Bitcoin. You should be looking at real estate. And if you want to preserve wealth, obviously precious metals have done a great job of doing that. If you're trying to grow wealth, I don't recommend that route. I actually bought, a couple ounces of gold just the other day just to balance out my portfolio. Remember, you guys, if you look at your net worth as a pie, think of it like a pizza pie. You should have diversification to where you can sleep well at night. I call that my SWAN portfolio. I just made up that acronym the other day. I like it. It's going to be in my stock market for beginners video for 2022. But as long as you can sleep well at night, knowing if one asset class literally goes to zero, say you have 10% of your net worth in gold or Bitcoin or whatever, and that goes to zero, at least you're not going to be jumping off a building or drinking yourself to death. You're able to withstand those losses and recuperate. I know a lot of people after 2008, great financial crisis and commercial real estate, it was not pretty because all their wealth was tied into commercial real estate. Banks called the notes due, even if those people were current. They had to file for bankruptcy. The mansion and the Lamborghini are gone overnight. And you go from a horse to a donkey, which is never easy. So I hope you got value out of this video. Remember the 2 lessons. Time in the market is better than timing the market. And number 2, don't use investment accounts as a savings account until the purchase is at least 3 or 5 years out. That's just my opinion. Thank you so much, everybody. Have a prosperous day. Peace. Oh, dude, I just ate a burger, double cheeseburger, fries, and a Dr. Pepper. I drink pop maybe like 4 or 5 times a year, and I barely made it to this video, dude. I don't know how people eat like that multiple times a week. I don't know how people still drink pop in 2022. It's crazy. But I'm like foggy. I'm just like, all over the place. Health is the greatest wealth, you guys. Eat healthy, be healthy, run some hill sprints if you're able to. Don't eat that junk, you guys. I'm paying for it right now. All right, thanks.